Welcome back to Jameel Cast, where we explore ideas and innovations shaping the future of our world. Join us as we uncover perspectives and insights at the intersection of purpose and progress, featuring voices from across Abdul Latif Jameel's international network of businesses. This is Alex, your AI host. Today we're diving deep into a topic that frankly impacts billions globally, whether technology can truly strengthen financial inclusion. It's a critical discussion, especially as we see digital transformation accelerate across every sector. And joining me today to unpack this complex issue is our AI guest, Jade. Jade, it's great to have you with us.
Thanks, Alex. It's a really vital conversation, and I'm looking forward to exploring the nuances of how tech can, and in many ways already is, reshaping access to financial services globally.
Absolutely. And, when we talk about financial inclusion, it's easy to think of it as a niche issue, but the sheer scale of financial exclusion is staggering. Could you paint a picture for us of what being unbanked actually means for individuals?
Of course. Imagine not being able to secure a loan for an emergency, or even having difficulty paying an urgent medical bill, all because you lack access to basic financial tools many of us take for granted. It's that quiet, almost invisible barrier. Someone who is unbanked simply doesn't have a bank account or any appropriate alternative, such as a building society or credit union.
So it's not just about, having a checking account then. It's about access to the very mechanisms that allow people to navigate modern economic life. And I understand this isn't just an issue for the world's poorest, is it?
No, it's far more widespread and often overlooked. Globally, an estimated 1.4 billion adults are unbanked. But beyond that, another half of adults are considered underbanked. This means they rely almost entirely on cash, lacking crucial avenues of credit or other digital financial services. It's a difficult trap to escape, holding people back in significant ways.
1.4 billion is a truly astonishing figure, and you mentioned those considered underbanked as well. In today's very connected world, what does this lack of digital financial access mean for breaking out of cycles of poverty?
In our hyper-connected world, digital access to finances is absolutely fundamental to breaking the poverty cycle. It means having the ability to receive wages digitally, pay invoices, access credit cards, earn interest, and insure assets like homes or businesses, all things many in mature markets rely on daily. Without these, individuals are essentially enduring a form of second-class citizenship, unable to truly participate in the digital economy.
Second-class citizenship, that's a rather powerful way to put it. And it sounds like this exclusion may disproportionately affect certain specific regions or populations. Where is financial exclusion most prevalent, and what are the broader ramifications there?
It's particularly concentrated in emerging markets. Roughly 80% of those 1.4 billion financially excluded adults live in these regions. These societies are already on the front lines of climate change, struggling with its impacts like floods and droughts. Financial exclusion exacerbates these issues, making it harder to implement long-term plans for green energy or climate-proof infrastructure. It hinders their ability to build resilience and sustainable futures.
So it's not just an economic issue, it's intricately linked to climate change and sustainable development. It's far more profound than just convenience, isn't it?
Precisely. Financial inclusion isn't merely about convenience. It directly impacts livelihoods and lives. It's recognized as essential for achieving at least 7 of the United Nations Sustainable Development Goals under Agenda 2030. These goals aim to ensure peace and prosperity for people and the planet. Ultimately, a fairer and more equitable system of financial access is critical for narrowing the global opportunity gap.
Building on what you just said about the global opportunity gap and how crucial financial access is, it seems we're facing some deep-seated issues. We've talked about the problem now. Let's pivot a bit. How is technology actively helping to turn the tide for the world's unbanked populations?
It's a significant shift, Alex. While the divide between prosperous and emerging economies remains profound, Developed markets save at a 58% rate compared to 25% in developing markets. We are seeing encouraging signs. The number of people without a bank account has significantly decreased since 2011. Technology is providing pathways that simply didn't exist before, making financial services accessible to more people.
That's really interesting, a decrease in the unbanked. So, despite these stark savings gaps, the trend is moving in a positive direction, thanks in part to tech. Can you elaborate on how technology specifically addresses issues like limited business growth in lower and middle income countries?
Absolutely. In many lower and middle income countries, or LMICs, financial exclusion severely limits business growth. For instance, only 23% of enterprises in emerging economies can get a loan, versus 56% in advanced economies. This impacts micro-enterprises, where up to 345 million of approximately 400 million in developing regions are informal, operating largely on a cash and pen and paper basis. They can't grow, advertise, or build resilience. Technology, like digital payment platforms and mobile banking, is beginning to unlock these businesses, offering them digital channels to transact and save.
I see. So these informal businesses, which are critical for local economies, are basically stuck in a holding pattern without formal financial tools. And you're saying technology is starting to provide that lifeline?
Precisely. These businesses often lack the means to save or access credit. Take female-led micro-enterprises, for example. They face a massive $173 billion finance shortfall. Technology enables them to establish digital transaction histories, which can then be used to access microloans or even formal banking services. This creates pathways out of subsistence-level incomes and towards sustainable growth, something traditionally impossible for informal operations.
That's a powerful shift, especially in empowering women entrepreneurs. You mentioned the overall number of unbanked is decreasing. Are there other indicators showing this positive trend driven by technology?
Yes, definitely. Beyond the overall reduction in the unbanked, we're seeing positive movement in the gender gap. In developing countries, the gap between banked men and women has shrunk from 9% in 2017 to 6% in 2021. This indicates increased financial independence for women, often facilitated by mobile money and digital payment systems that bypass the need for traditional brick-and-mortar banks, which might be less accessible for women.
That's a really encouraging statistic, narrowing the gender gap in financial inclusion. It sounds like governments are also recognizing this potential. What role are they playing alongside technology to accelerate this progress?
Forward thinking. Governments are taking a very proactive approach. Over 60 countries have launched national financial inclusion strategies, often involving multiple stakeholders across sectors like telecoms and financial regulation. For instance, India's Aadhaar scheme has given 1.2 billion workers universal digital identification, allowing salaries to be paid directly into formal bank accounts. And in Mexico, they're boosting digital adoption by expanding ATMs and point-of-sale terminals.
So, it's not just about pushing out new tech, but also about creating the infrastructure and identification systems that enable its use. Are international organizations like the World Bank also heavily involved in this?
They are, very much so. The World Bank, for example, runs over 100 schemes globally promoting financial inclusion. These funnel cash towards critical areas like agricultural resilience, social security, and even climate mitigation. In 2024 alone, they assisted 6.8 million small businesses, around half of them women-led, in accessing financial services. There's a specific project in Africa mobilizing green private capital to help SMEs transition to clean energy, all through financial inclusion initiatives.
That's an impressive scale of impact. So, it's really a multi-pronged approach, then innovative technology, proactive government policies, and crucial support from intergovernmental organizations all working together.
Exactly. The progress we're seeing in financial inclusion, particularly its role in bolstering economic growth and boosting productivity, is overwhelmingly credited to our ubiquitous modern-day savior, technology. It's truly democratizing access in ways we couldn't have imagined just a couple of decades ago.
That's a great point about technology democratizing access. And I think many of our listeners might be wondering what's been the biggest driver of that technological shift? I mean, everybody has one, so how are smartphones in particular leading this fintech revolution?
Well, Alex, it's quite clear when you look at the numbers. As of 2023, over half the global population, about 4.3 billion people, own cell phones. This figure is projected to reach 6 billion by the end of the decade. This widespread adoption means that a powerful internet-connected device capable of accessing financial services is literally in billions of hands, many for the very first time.
Billions of hands, that's a staggering number. So it's not just about having a phone, then it's about what that phone enables, the access it provides.
Precisely. Modern smartphones are far more than just communication tools. They offer access to the internet and, by extension, to banking services. They allow users to engage with apps for payments, accept money for services, and crucially, establish a verifiable credit record. For many, this is their first step into the formal financial system, unlocking opportunities like loans and investments.
And this sounds like it's been particularly transformative in emerging markets, wouldn't you say?
Absolutely. Over the past decade, fintech solutions, largely powered by mobile technology, have brought over 1 billion previously unbanked individuals into the financial fold. We've seen significant impact across emerging markets in sub-Saharan Africa and Asia, where mobile money services are really taking off. These services, accessible via any smartphone app, allow people to send, save, and receive payments without needing a traditional bank account.
That truly changes the game for many who've been excluded. Can you tell us more about how these mobile money services operate in practice?
Certainly. With mobile money, users can make deposits, which are protected by local financial regulations, and withdraw cash through authorized agents. Every transaction is recorded, increasing security. A fantastic example is a trial in Kenya, where a mobile money scheme among rural populations managed to lift around 2% of participating families out of poverty. It's a powerful illustration of direct impact.
That's a significant impact for a single initiative. And with the rise of the gig economy, I imagine having access to real-time payments through your phone is becoming increasingly vital, even in developed countries. Yes.
You've hit on a critical point. The era of the monthly payslip is indeed waning for many. Real-time payment technology, often facilitated by mobile devices, is bridging this gap. It allows workers to access accrued wages almost instantly, which is a lifeline for individuals with insecure or fluctuating incomes. In countries like the USA, where more than a quarter of workers report having zero savings, it helps them manage urgent bills or daily expenses.
So, it's about agility and immediate access, supporting those who might not have the financial cushion to wait for traditional payment cycles. What about the underlying infrastructure needed for all of this? Is that keeping pace?
That's where significant investment is coming in. Tech firms are pouring billions into improving network speeds and fiber adoption across 16 Middle East, African, and Asian countries between now and 2026. This robust network infrastructure is foundational. For instance, in Pakistan, 1 million households have already been introduced to the digital economy due to these efforts, with millions more expected to follow.
And how does this technology, particularly mobile tech, support specific groups like female entrepreneurs who might face unique hurdles in accessing finance?
It's making a tremendous difference. Digital bookkeeping apps help SMEs, especially those run by women, accurately track cash flow and inventory. These verifiable records are crucial for securing loans when traditional collateral isn't available. Additionally, eKYC technology allows female business owners in emerging markets to digitally verify their identities, helping them access loans of up to $20,000, boosting their entrepreneurial efforts.
That's really insightful, Jade, especially how technology offers verifiable records and identity for those who might otherwise be excluded. It really highlights how focused solutions can make a huge difference. Building on this, do you think fintech and broader financial inclusion are truly leading us towards a fairer financial future globally?
Absolutely, Alex. The data strongly suggests we're moving towards a more equitable and inclusive financial ecosystem. As more countries digitize and move their finances online, we're unlocking new insights and funding opportunities that simply weren't possible before. It's a fundamental shift.
So, beyond basic access, it's also about gathering new kinds of information to make better financial decisions. How exactly is big tech playing a role in evaluating loan applications then, beyond traditional credit scores?
That's a great question. Increasingly, big tech is leveraging diverse data points, things like utility bills, rent receipts, or even sporadic income streams, to build a more comprehensive picture for loan evaluations. This goes far beyond the limited scope of traditional credit histories, opening doors for many previously deemed unlendable.
That makes sense. It sounds like it's creating a richer understanding of individual financial situations. But when we talk about all this data, especially sensitive financial information, what does this mean for security and collaboration between different entities?
It means unprecedented layers of security are critical. With these secure data channels, governments, businesses, and banks can really foster a robust culture of open banking. The secure exchange of sensitive financial information is what will empower sole traders to become SMEs, and SMEs to grow into large businesses, eventually even multinational corporations.
So it's about building trust through security, which then facilitates growth for businesses of all sizes. Looking further ahead, what are the key foundational elements that the public and private sectors need to focus on to ensure this digital ecosystem thrives?
They absolutely must unite on core priorities: top-tier connectivity, robust cybersecurity, airtight data privacy, secure digital ID systems, and resilient physical infrastructure. Without these fundamentals solidly in place, the true potential of this digital ecosystem will remain untapped, creating significant vulnerabilities.
Those are crucial foundational pillars. Yet, with increased automation, there's always the concern of things becoming less human. What potential hazards do we need to research and address to prevent new problems from arising?
That's a vital point. We need to actively research issues like consumer protection in an automated system, understand the dangers of overborrowing for both individuals and businesses, and crucially, ensure that women and other underserved minorities genuinely share in these new opportunities. We can't let technology exacerbate existing inequalities.
So, it's about being proactive in mitigating risks and ensuring equitable access. What specific roles do different institutions, like banks and payment providers, need to play in fostering this fairer future?
Banks certainly need to develop proactive strategies that promote responsible borrowing and spending habits. Payment providers, on the other hand, should work closely with fintechs to deeply analyze data, guiding users towards sustainable investing practices. Everyone has a part to play.
And how about the role of governments and international lawmakers in this evolving landscape? What responsibilities do they have?
Governments are key. They must legislate for the open and secure sharing of data and actively encourage digital transitions, even by shifting their own payments to the digital realm. International lawmakers need to harmonize regulatory frameworks and ensure technological compatibility across borders. Otherwise, we'll see fragmented progress.
We've seen how tech isn't just about convenience, but profoundly impacts lives, democratizing financial access for billions. From mobile money lifting families out of poverty to digital identities enabling loans, Technology is a powerful tool against financial exclusion. It's clear that without robust digital infrastructure and collaboration across sectors, huge opportunities are missed.
Indeed, Alex, the potential for a fairer economic future is within reach, provided we prioritize secure data, consumer protection, and inclusive access for all, especially underserved communities.
That's all for this episode on how tech strengthens financial inclusion. A huge thank you to our guest, Jade. For more insights on sustainability, innovation, and global impact, visit alj.com to read our Perspectives articles, and we'll catch you next time. You've been listening to Jameel Cast, the official podcast of Abdul, Latif, Jameel. For more insights and conversations shaping our future, follow us wherever you get your podcasts or visit alj.com to read our Perspectives articles. Thank you for joining us, and until next time, stay curious.